Hello, we're live. I'm going a little bit early today. So if you notice in your notifications on YouTube, Facebook, LinkedIn, or Twitter, and you see me live, it is the real deal. I have to get out of here a little bit early today. Tonight is the opening for Marvel's Metaverse Madness Doctor Strange. I'm taking my kids and five of their friends, and I don't want to disappoint them in spite of the market plunging today. And you'd think that would be a really good day for a lengthy live stream at 4:30. I have to get out of here early because I'm not going to disappoint the kids, and that's part of being in the business. 32 years in the business, there are always those days, big ups or big downs. You could be on vacation. You could be out, taking a 3-day weekend, whatever, out for the afternoon at an event. There's always a reason to pull you back into the office. And after 32 years of doing this, I can tell you, don't change your plans based on how the market does. It's never a good thing, and you will look back in your life and regret it. That you're like, why did I not do my plans? Because just like those big down days you had in 2020 and many times before, they pass. We forget about them. We're on to something bigger and better. You get older and you look back and say, it's not that I regret what I did. I regret the things that I didn't do. Just a little tip for when you get older. Okay. So if you have any questions about what we're talking about, hit me up in the comments. Words of wisdom, words of encouragement are always appreciated. Michael, I see you out there. So we're going to talk real quick today about the market. It plunged yesterday. The market took off like a shot, though. What a great day. The Fed came out yesterday and said we're raising, as expected, we're raising rates 50 basis points, the federal funds rate, short term. Okay. And we're going to reduce the $9 trillion balance sheet even slower than what you expected. The market took off. Fed said we're not contemplating raising rates 75 points in one shot. There were just a lot of good things yesterday to soothe investors' worries about Fed policy, the stock market, interest rates, etc. Today, complete opposite. What the hell happened? I thought yesterday, I was thinking going into today that we would have some follow through, that short covering would take place today, maybe reduce pressure on the margin selling. There's really not a whole hell of a lot of great reasons that I could find for today's down day. And at one point, it did feel like a flush. The major averages did wind up bouncing off of their lows of the day. So that's a good thing. Uh, what did I do today? I didn't do any buying yesterday. I just let the market go, do what it does, whatever. Great. I had already done a little bit of buying the previous step. We talked about that. Today, not only did we give back yesterday's gains and then some, especially in the Nasdaq and the S&P 500. By the way, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. But I did buy a couple of things today. I bought some tech, I bought some industrials, some financials, consumer staples, and I bought a mid cap ETF in client accounts, sprinkled it all around. Today was a day that felt a lot like a flush. Now, I'm not saying that today is the bottom. And I've been in the business when the NASDAQ went down 80%, and we're not even close to that. But, history repeats itself. It's not exactly the same, though, as it was back then. And I've been saying this forever on the live stream that we are so similar to 2000. The tertiary, secondary stocks went down. I talked to you about ARK funds over a year ago saying, this is not a good fund, a good place to be in. And we went through all of these stocks, okay, and the expense ratio and what's in it. And my conclusion was it's just a momentum portfolio with a momentum based manager, Kathy Woods. Kathy Woods? Or is it Kathy Wood? Okay. And when the pandemic stocks go down, this fund's going down with it. Because these stocks in the fund went up solely because of the circumstances surrounding work from home and stay at home. And unless we get that again, I don't see why these stocks would do what they did. They were way, way overpriced. I said the same thing about another ETF, the meme ETF, MEME. I could post them again on social media if you want. Just let me know. Anyway, that has continued, and the work from home, stay at home pandemic stocks continue to get crushed, see new lows. This is like my symbol for crushed. I pound my fist into my hand, right? Arr. I'm not angry though. I don't get angry about the market. I'm doing this too long. Just another day for me. All right. Anyway, we're going to talk about these things. And I just realized I haven't rolled the intro. And then I want to give the show like a good 8-10 minutes and we're going to get out of here. So here we go. All right. For something, I wasn't sure if the intro was completely done or not, but that's the vagaries of live streaming. Okay. So let's take a look at the boards today. Put myself in here. All right. First, the 30-year mortgage rate went up to 5.62%. So all you people are thinking rates are up as high as they're going to go, I'm not going to lock in yet. Here you go. I don't like to play with interest rates. I'm not the best at predicting day-to-day interest rate moves on the 30-year mortgage. Maybe someone you know is. I don't know anyone who is. It's all based in the bond market. So how a mortgage broker would know is beyond me. I follow the bond market, which determines mortgage rates, and it's not an easy thing to do. Okay. I'm a financial pro. Okay. There you go. Let's take it to the big board here. I'll make this a wee bit bigger for you. Oh, too big. Okay. So Dow down 1,000 points. It was down over 1,300 at one point. We were up like 980 points yesterday. So between the 2 days, 50, 60 point, 70 point give back, not that big of a deal. The NASDAQ, though, really tanked, 5% drop in the NASDAQ. And the S&P, which has a lot of tech stocks, it's very tech heavy because the biggest companies in the world are tech and they're in the S&P, down 3.5%. Gold was only up a little, still under 1,900. Oil was up a drop. It had a big up day yesterday. The 10-year Treasury above 3%, closing yesterday. The 10-year Treasury closed yesterday. The 10-year Treasury touched 3%, but didn't close there. Today it closed over 3%. If I have to pull out a culprit of what drove stocks down, was this right here. The 10-year Treasury closing above 3%, where investors finally said long-term rates are up. They're staying up. We're solidly into the threes. We're going to stay that way. And the high duration stocks with either no earnings or extraordinarily high P ratios, those are the ones that really took it the hardest, like Etsy, for example. Okay. The VIX was way up, back over 30. This just reversed everything good yesterday. It did, we're talking about technicals and it would reverse some of the bad technicals that were developing. Nah, one day wonder by far. So here's what I could say about the yesterday, the one day wonder and the technicals. Yeah, that was kind of weird, wasn't it? It was, I've been, trying to find like the perfect time for that. And, I finally, well, I'm doing the best I can. Okay. All right. Let's take a look at the bonds. Short-term yields were down slightly, opposite of yesterday. Longer, the further out you go, the more yields were up. But the 10-year at 3.038, the 5-year at 3.008. The yield curve is still normal, steep. So that is actually, I think, a net positive by most people's count. By mine, it is. Crypto always says it's got a high beta. Meaning, whatever the NASDAQ does, it seems crypto will do, but it will do to a greater extent. If the NASDAQ was up 4 or 5% today, you'd probably see crypto go up 10%. NASDAQ was down 4 or 5%. You see crypto go down 9%. I'm talking specifically Bitcoin. Okay. Let's keep going. Sectors. Which sectors did the best today? The best sector was still down 1%, was utilities, then energy, and it just gets worse and worse from there until you get to the cyclical stuff. Industrials down over 2%, financials down almost 3%, technology down almost 4.8%, discretionary down almost 6%. That is heavy. And if you look at the red line over here where I'm moving my cursor, 215 down to 158, that's the distance between the year low and year high. And we're right just at the year low right there. That is just, that's pretty heavy. All right. So that's the story for today. Today was a day where people just decided to get out of the high beta stocks, in particular the NASDAQ stocks, which were the kings and queens of the pandemic. And money coming out of those is pulling money out of everything else. Look, we'd always talked about this, that as long as the super large cap stocks hold up, the Facebooks of the world, the Netflixes, the Nvidias, the Amazons, Microsoft, Google, which is actually Alphabet, okay, as long as those could hold up, the major averages would hold up, and you haven't noticed the carnage unless you're in individual stocks. But eventually, when that catches up to the large cap stocks, and I felt it's a matter of when, not if. We've been talking about this. I have this timestamp like a gazillion times. We finally see the major averages cracking because those stocks are finally taking it on the chin. And that's really what's driving the market. And until those reverse, there's not much you can do about it. It's these big stocks over here. I mean, look how bad this is. Apple down over 5.5%, Amazon down 7.5%, Facebook down 6%, almost 7%, Google down almost 5%, Microsoft down over 4%, and Nvidia down over 7%. You're not going to have an up day in the market when these stocks are all down 4, 5, 6, and 7%. I'm not even showing you that. Let me show you this, okay? You're not going to have an up day when these stocks are down between 4 and 7%. You're not going to have it. That's what really did it today. The spark was a move in long-term rates. Now, why are people? I just want this is how it works. Yesterday, there were a parade of people on air and print and web saying, we're too nervous about inflation. Inflation's going to cool down. Market's oversold. Everything's going to be great. And today, we should have never gone up yesterday. Inflation's going to go a lot higher. We're not oversold. Interest rates could go a lot higher. Now, my experience is people who are dragged out into the media to talk to us about what's going on in the market. The people who are chosen depending on a bullish or bearish view. And for the most part, if the market's up a lot, you're going to get a lot of people saying it should be up, everything's fine. And if it's down a lot, you'll get people saying things are awful, everything is not going to be good, and it's all over. And that's what we got yesterday. That's what we got today. So what do you do about it? Now that we know why, what do? You don't panic. I spoke with an investor today, and he asked me, should I sell stocks? We know we're going into recession. We know the market's going to go down. We know it's going to be a really bad bear market. How does he know this? We know this. We know that. Sounds like you've been listening to someone on TV, maybe. We don't know for sure. And the economy and the stock market are two different things. If you recall, the economy was pretty lousy 2020 and 2021. Stock market went up a lot. Just because we go into recession, it doesn't mean the stock market has to go down and stay down. The stock market and the economy are not always linked, and they could do very opposite things. There's so many variables that impact stocks, and the economy it's a big one, but it's just one of many. So do's and don'ts. Don't try to, in my opinion, try to time this. If you think you're going to get out now, after stocks are down 20, 30% on quality large cap blue chips, I'm not even talking about like the pandemic stocks. I'll show you what the pandemic stocks are and how bad they are. Look at this. Peloton, 129 to 17. DoorDash, 257 to its close at 73. DoorDash was even higher a long time ago. I'm just going back a year, but if you went back like 2 years, it would have been even higher. DocuSign 314 closed at 80. I mean, this is a bubble popping. Roku 490. It was higher at one time. Domino's. I mean, Disney, Clorox. The only reason Activision is even holding up at 78 is because Microsoft is taking them over. Had not been for Microsoft, I bet you Activision would probably be like a $20 stock right now. Campbell's is holding up okay, consumer staples. But the tech related or consumer tech related type companies all got crushed. All right. Those are dragging everything else down. So what do you not do? First, you have to understand that the risks for a investor in individual stocks is different than someone who's investing in, for example, a portfolio of. And I'm just keeping an eye on the clock. I have to get out of here soon. They're different than someone who's just investing in a asset allocation model of index funds. Okay, but don't try to time this. Don't try to just sell everything and think you're going to get in at a lower price. You have no idea what the bottom is going to be. I just know that as the market goes lower, I do a little nibbling. Maybe I'll hit the bottom. Maybe it's in front of me. Maybe after today, it's behind me. I don't know. I'm not basing my self-esteem on whether I pick the bottom or not. I'm following a process. It's probably not in yet, the bottom, but we just don't know. And every time I hear somebody say the bottom's in lately, they're always wrong. I don't have to pick a bottom. I just have to invest consistently, make sure my portfolios are in line with my clients' risk tolerance, time horizon, financial goals, that their plans are in place. These are the things that I do, okay? But I want you to take control of your money and don't do something rash. So don't just get out and think you'll get back in later, because if you do, you're never going to get back in, or you're going to get back in after everything goes up. And that could be in a couple of years. And you'll have missed compounding, reinvesting dividends. And by the time you see the market up, it'll have already been even higher than it was previously. I've never seen a market that hasn't recovered. Have you? Okay. So then what happens is if you get out, the market goes lower, then you think, well, I'll wait till it goes lower. Then the market goes up, and then you say to yourself, wait, I could have bought in early, lower. So wait for it to go back down again. And the market goes down, and you say it's going to go lower, then it goes up, and you say I could have bought it lower. It just goes back and forth. It becomes endless procrastination. You have to pick a point and invest. Okay. There are different ways to invest. We could talk about that. But this hesitation, this procrastination, this procrastination does not work. What should you do? If you are like this person who asked me, we know we're going in a recession. We know we're going to have a bear market. We don't know for sure. And maybe if we go into a recession, a bear market, this person will say, aha, I told you so. But I know this is not somebody with that kind of financial sophistication. It's guessing. You think it is. I can't guarantee either any outcome either. Okay. And I do this for a living every day for over 30 years. But we want to, if you're young, we could define young in different ways. But if you're still accumulating wealth for your retirement days, for the distributive days of your wealth, when you need to live on your passive income, on your investments, keep investing. A down market is your friend. You've all been buying stocks on the way up. How about trying to buy stocks on the way down? On the way down. That's what you should be doing. So these are the main do's and don'ts. If you have something that's really junky, low quality, and you really feel that it's not going to recover, you could always sell that and go into something better. The stocks that you recover in, or the investments that you recover in, do not have to be the stocks that caused a loss for you. Okay. You're allowed to be in different stocks, but you have to see what you have, what's worth holding on to, what's worth sticking with. And that even comes down to a matter of personal judgment. And if you don't like to make these decisions, you don't want to do the homework, or you're just too afraid of making a mistake, that's what mutual funds, exchange traded funds, index funds, whatever, that's what those are for. And there's nothing wrong with that. The most important thing is you know what you're like, you know yourself, so that you could go forward and stick to your plan. Sticking to your plan is more important than anything. As we like to say, time in the market is more important than timing the market. Okay, that's it for today's show. I'm I'm going to hit the road. I really appreciate you all sticking with me. If you missed the beginning, go back to it. This show will be on my timeline on LinkedIn, Facebook, Twitter, and YouTube. If you think of anything you want to ask me afterward, go right ahead. I'll see it in the comments. I'll get the notification. I love hearing from you. And I usually don't do the live stream on Fridays, but it seems every Friday we have 1,000-point down day. So I've been doing them on Fridays lately. So we'll see what happens tomorrow. All right. Have a great night. Thank you very much. And I'll give you my little review next week on the movie Metaverse Madness with Doctor Strange. All right. Good night.